Welcome to Sheen Research, your strategic partner in comprehensive investment analysis. Today we're focusing on Apollo Global Management, ticker APO. We're going to be digging into their recent Q3 2025 earnings call and, really picking apart their latest financials.
Right.
Our goal here is to get way beyond just the press release headlines. We want to investigate and really synthesize what's driving their strategy and their financials as of Q3. I'm especially interested in, a few things. First, the real story behind their growth numbers. Is it as good as it looks? Second, the shifts happening inside Athene's profitability, specifically with spread-related earnings.
Which is so critical.
Exactly. And finally, the outlook management gave. What are they saying about their origination engine and the market opportunities they see coming up?
And this is a really critical moment for Apollo. You have to think of them as two integrated businesses now. You've got the asset management side, the AM side that's generating all that fee income.
The traditional side.
The traditional side, yeah. And then you have the retirement services side, which is Athene, acting as this massive source of permanent capital, generating spread income.
Right.
So Q3 gives us a really vital snapshot of how well that whole integration is scaling up, especially as they're bringing in a huge acquisition like Bridge Investment Group.
All right.
And maybe more importantly, how their credit portfolio is holding up with all the macroeconomic pressure out there. We need to compare Q3 not just to last year, but, sequentially, to Q1 to Q2. That's the only way to really see the trends.
So is this acceleration we're seeing sustainable, or is it just noise?
That's the question. That's what we need to figure out for you.
Okay, let's unpack this. We have to start with the headline numbers because, frankly, they were just outstanding. This quarter was a huge beat on almost every metric. So looking at the standard Wall Street metrics first, Apollo really delivered a powerhouse quarter. GAAP EPS, it came in at a remarkable $2.17.
Yeah.
That number alone just crushed the consensus estimates. By a margin of $0.27. That feels like a huge sign of momentum.
It certainly is, but you have to connect that to the top line. The GAAP revenue hit $1.15 billion.
Which also beat expectations.
It did, by about $48.32 million. And when you look year over year, the scaling is it's undeniable. That $1.15 billion is a 23.97% increase in GAAP revenue from last year. So they're not just growing, they're actually accelerating.
And here's where it gets almost surreal. When you look at the sequential numbers, the GAAP net income for the 3 months of Q3 was reported at $2,461 million.
A huge number.
A huge number. Now compare that back to Q1 of this year, when GAAP net income was $938 million. That's nearly a $1.5 billion increase in net income in just 2 quarters. That kind of jump seems, extraordinary.
It is extraordinary, but, and this is a big but, we have to treat GAAP net income with some caution, especially for a company like this with a massive insurance business like Athene attached to it.
Okay, why is that?
Well, while the number itself is massive and it does reflect really strong market performance, a lot of that rapid acceleration, that nearly $2.5 billion, is often driven by non-cash market movement. Yeah, primarily derivative gains from how Athene hedges its liabilities and marks on equity investments. So it signals great portfolio performance, yes, but it doesn't necessarily mean there's a proportional jump in their recurring cash earnings.
So if the GAAP figure is noisy, what's the cleaner metric we should be focusing on to really see the health of the actual operations?
You have to focus on 2 things. Fee-related earnings, or FRE, for the asset management side.
Right.
And spread-related earnings, or SRE, for the retirement services side. Those are the metrics management themselves use to gauge their core recurring profitability. The massive Q3 net income is great for headlines, great for book value, but the stability and growth of FRE and SRE tell us if the core machine is fundamentally sound.
The origination, the asset gathering, all of that.
Exactly. The investment spread management, we see the JAP noise, but we have to drill down to those reliable earnings components.
Okay, let's pivot then. Let's talk about the asset management side, where those recurring fees live. AM revenue hit $1,487 million in Q3. That's a huge sequential leap from the $1,046 million in Q1.
Almost $440 million of growth in 6 months. It's a big jump.
It seems like management fees are the stable foundation here.
They absolutely are. Management fees are the bedrock of FRE. And they climbed steadily, reaching $606 million in Q3, up from $508 million in Q1. That's a 19.3% sequential increase. It confirms that the AUM growth we're about to talk about is converting very efficiently into revenue.
Right, and we can actually see the drivers of that $98 million sequential increase pretty clearly in the filings. They give us a lot of visibility into where the money's coming from.
They do, and it's a mix of organic scaling and successful inorganic integration. On the inorganic side, you have the newly acquired bridge funds. They added an immediate $20 million increase.
So that's instant revenue.
Instant revenue boost from that acquisition.
Yeah.
But the organic engines are also really firing.
Right. Like Atlas, their asset-backed specialty lender.
Yeah.
That delivered a $30 million increase, and that was largely due to higher fee-generating AUM from upsizing warehousing financing facilities.
Right.
So for the listener, what exactly is Atlas doing that creates that kind of fee acceleration?
Okay, so think of Atlas as Apollo leveraging what they do best, which is structuring complex collateralized financing. They're bridging the gap between, say, non-bank lenders and the institutional market.
Okay.
By increasing its warehousing capacity, which is basically its ability to temporarily hold and structure huge pools of these assets, it captures fees immediately on the origination and the servicing. It's a proprietary fee engine that's tied directly to their expertise in complex credit.
We also saw strong contributions from their flagship funds.
Yeah.
ADS, Apollo Debt Solutions, that kicked in another $20 million increase.
Right, and that was driven by strong subscriptions and inflows. Clients are clearly eager to get access to their direct lending capabilities.
And on the private equity side, AIOF Third, that's the Apollo Infrastructure Opportunities Fund 3, added another $9 million. They said that was from catch-up management fees on new capital closes. It really paints a picture of fundraising success across all their major strategies.
It's a very complete picture of momentum, I agree. But we also have to acknowledge the natural life cycle of these funds, you know. We did see some offsetting declines. They're normal, but they're important to note.
Correct. The maturity of some older funds led to some modest declines. Specifically, Private Equity Fund 9X saw a $7 million decrease.
That was a planned fee rate step down, right?
Yeah, as it moves further into its investment period. And Fund 8, which is an even older vintage, that saw a $4 million decrease as its fee-paying period expired altogether.
So the key takeaway here is the balance. The new high-growth stuff, Atlas, Bridge, ADS, AIOF, they generated way more revenue than the old maturing funds shed. And that confirms their asset generation flywheel is turning faster than the portfolio is running off. That is the definition of healthy, accelerating FRE growth.
Okay, moving on to the less predictable but high-margin part, advisory and transaction fees. This category saw a massive spike. It hit $378 million in Q3. That's almost double the $195 million they reported back in Q1. What explains that phenomenal increase?
This is a classic indicator of a hyperactive deployment and transactional period. I mean, these fees get realized when Apollo's capital solutions platform, ACS, underwrites, structures, or syndicates deals.
Or provides advisory services.
To their portfolio companies. And management specifically cited robust activity across 4 key sectors: financial services, manufacturing, and industrial, leisure, and natural resources.
So to double those fees in 6 months suggests some really intense M&A activity.
Intense M&A, high-volume capital raising, successful realizations across their portfolio. It's a great profit center, but you have to remember it is inherently lumpier than the management fees.
So this signals not just that they're gathering capital, but that they're successfully deploying it into complex deals. None of this revenue acceleration is even possible, though, without a massive engine sourcing the assets in the first place. We're talking about their proprietary origination platform. How quickly is that scaling?
The scale is, I mean, it's just stunning. The origination volume generated was $75 billion in Q3 alone.
Wow.
Management was very keen to point out this was their second highest quarter ever. If you just annualize that number, you get a sense of the sheer sustained volume they're putting up.
And the proof is really in the long-term metrics. The total origination volume over the last 12 months, it exceeded $270 billion.
And what's truly remarkable about that is that management emphasized that this number surpassed their own multi-year origination targets 3 to 4 years early.
They're way ahead of schedule.
Way ahead. That's the ultimate validation of this integrated model. You know, when they set these long-term targets, the market was skeptical. Could a single firm really consistently source high-quality private credit assets at a $250 billion annual pace?
And they've proven they can.
By hitting $270 billion this early, they've proven the engine works. This proprietary origination capacity is their core competitive moat. It allows them to feed both the asset management side and, crucially, the long-duration liabilities of Athene.
And this massive volume has a direct impact on assets under management. Total AUM ended Q3 at $859.6 billion. That's up $74.4 billion from the end of Q1. It's just steady systemic growth.
It is. And the net flows analysis tells us which parts of the model are actually driving it. For the 9 months ending September 30th, they reported total net flows of $138.1 billion.
That is an incredible amount of fresh capital.
A huge amount.
And the credit strategy is still the dominant force here.
Absolutely. The credit strategy accounted for $83.7 billion of those total flows, and this is where that integrated model just shines. The largest single component was $35.1 billion coming directly from retirement services clients.
So Athene.
That's Athene. It shows that every single dollar Athene collects in premium is immediately recycled into AUM for the asset management platform, which creates those management fees we were just talking about.
Okay, so beyond Athene, where did the other credit flows come from?
Well, they added another $29.9 billion in subscriptions from third-party institutional clients and wealth channels.
So outside money.
Right, across direct origination and opportunistic credit strategies. Plus, there was a significant inorganic boost of $9.3 billion from the Redding Ridge acquisition of Irradiant Partners. It's a multi-pronged approach.
And the equity strategy flows also saw a big injection, right? Up $27.5 billion, though we should be clear, that was heavily inorganic.
That's right. The Bridge acquisition, which we'll get into more detail on, accounted for $21.4 billion of that inflow immediately.
So Bridge is mostly an equity hybrid play in their accounting.
Right. While it's a real estate and opportunistic credit play, it often sits within or adjacent to their equity and hybrid strategies. It just shows the immediate impact M&A can have. You fast-track your AUM growth in an area that might otherwise take you years to build organically.
So if we just look at this whole first part, the narrative is really clear. Scale is accelerating everywhere, and it's all underpinned by an origination platform that's blowing past even their own aggressive expectations. Now let's move to the other side of the house, the liability matching powerhouse, Athene. This segment doesn't just generate profit, it provides that permanent, low-cost funding that lets the asset management platform really thrive.
The growth in Athene's net invested assets is staggering. They grew 18% year over year, hitting $286 billion. This massive pool of assets is what underpins their ability to generate spread-related earnings, SRE.
And SRE is basically the difference between what Athene earns on its investments and what it pays out to policyholders, the spread.
Exactly. The earned rate versus the cost of funds.
And the inflow machine was running strong. Q3 saw $23 billion in organic gross inflows. How was that $23 billion sourced?
It was strategically diversified, which is so important for risk management. Retail flows, which are mostly your fixed index annuities, FIAs, and MYGAs, the traditional products sold to individual savers, that accounted for $10 billion.
Okay.
Then you have funding agreements. These are institutional products sold to corporations or financial institutions. They brought in another strong $10 billion.
A nice balance.
A very nice balance. And finally, flow reinsurance contributed another $3 billion. This balance is key because if one channel slows down, the others can pick up the slack.
Well, let's focus on the key metric here, SRE. Q3 SRE ex notables was $846 million. The blended net spread, that vital margin, came in at 121 basis points.
And this 121 BPs S spread is where the analysis gets really critical. Management compared this to the prior quarter, Q2, which had a spread of 122 BPS.
So a 1 basis point decline.
Tiny. It's a marginal 1 basis point sequential decline. And while it is tiny at this scale, it's highly indicative of the pressures that Apollo is managing.
So even with massive new inflows coming in at what you'd think are higher deployment rates, the overall spread actually contracted a tiny bit. Why is that happening?
It's the constant treadmill of asset and liability matching. That slight decline reflects the effect of older, often very low-rate liabilities rolling off the books, while at the same time, the cost of new liabilities is rising rapidly because of the higher interest rate environment.
I see.
New business growth is offsetting this, but the margin for error is shrinking, just slightly. They are running really hard just to keep that spread stable. Management is successfully sourcing high-yielding private assets, but they're also paying more for the policyholder funds than they were a year ago.
Still, maintaining a 121 basis point margin on $286 billion in assets.
It's still a fantastic achievement. It confirms stability at massive scale.
Let's dissect that 121 BPS spread then. Starting with the liability side, the cost of funds. This is the rate Athene is paying out. In Q3, it was 3.79%. That is up significantly, 33 bps sequentially, from Q1's rate of 3.46%. That's a substantial increase in just 6 months.
It is, and it tells us a strategic story. Management attributed that increase to three core factors. First, the higher rates they just have to pay on new business to be competitive.
Makes sense.
Second, the runoff of old, lower-rate business, which naturally pulls the blended cost up. And third, a conscious shift in their business mix. They're moving more toward institutional products like those funding agreements, which usually require higher crediting rates than traditional retail annuities.
So they're choosing to pay more.
They're choosing to pay more because those institutional liabilities are larger, they're stickier, and they provide more immediate scale.
The counterpoint, thankfully, is the net investment earned rate, what Athene is making on the assets it buys. Q3 saw this rate hit 5.34%, a solid 45 bp sequential jump from the Q1 rate of 4.89%. That more than compensates for the higher cost of funds.
This is the crux of the entire Apollo model. Their origination has to generate a higher positive delta than the increasing cost of their capital, and it is. If we break down the asset performance, the fixed income portfolio, the safe, large portion, its earned rate, rose to 5.12% in Q3. That's up from 4.80% in Q1. That shows the capital deployed over the last 6 months went into significantly higher yielding fixed income instruments.
What about the alternatives earned rate? That's typically higher but more volatile, is slightly down sequentially, right? Settling at 9.88% in Q3 compared to 10.08% in Q1. What caused that small dip?
Yeah, Q3 was kind of a mixed bag for alternatives. They had highly favorable performance in certain retirement services platforms. They specifically noted a valuation increase on the Venerable platform related to their reinsurance deal with Corebridge.
Okay.
And their equity funds performed well. However, this was slightly offset by less favorable performance in some of their origination platforms, most notably a lower valuation increase in the Wheels specialty finance business compared to the exceptionally strong marks they saw back in Q1.
So it's still running near 10%.
Right. The overall alternatives portfolio is still near 10%, which is a huge driver of their spread. But this sequential dip is just a reminder of the inherent volatility you get in private marks.
So stability in alternatives, even with small fluctuations, combined with rising fixed income returns, that's what's driving the overall earned rate higher.
One of the most important strategic insights from the call was how Athene has successfully diversified its liability base beyond just its core fixed index annuities.
To avoid over-reliance.
Exactly. You don't want to be reliant on a single product line.
So what new products are emerging as growth areas for them?
They're successfully scaling products like RILA registered index-linked annuities. These are variable annuities tied to market performance, but with downside protection built in.
And people are buying them.
Oh, yeah. They reported over $1 billion in RILA inflows year to date. That suggests strong adoption in the retail channel. And they're also expanding into stable value, structured settlements, tax-advantaged products, and various guaranteed income strategies. It's all about making sure that liability funnel stays wide and deep.
And on the risk management side, management was very firm about Athene's strong liquidity position, especially when it comes to rate risk.
They emphasize that Athene is, quote, largely immunized against floating rate exposure. Their sensitivity to interest rate fluctuations is apparently at the lowest level it's been in a decade.
And how do they achieve that?
Through careful duration matching and hedging. It minimizes the risk that a sudden rate shift could hit their solvency or profitability. They also maintain substantial undrawn liquidity facilities at AHL, the holding company, ensuring they have immediate access to cash if they need it. This strong liquidity profile is absolutely essential for executing those huge, large-scale reinsurance deals.
Okay, let's talk about M&A, specifically the successful integration of Bridge Investment Group, which closed in Q3.
The completion of the all-stock Bridge acquisition on September 2nd was a really critical strategic move. It instantly broadens Apollo's footprint in real estate, especially in that individual wealth channel, and it expands their opportunistic credit platform.
The transaction was structured through some very specific exchange ratios. Each share of Bridge Class A common and each LLC unit converted into 0.0007081 shares of AGM common stock.
Right, while each share of Class B was converted into a nominal 0.0000006 shares. But from an accounting perspective, Apollo provisionally valued the total identifiable intangible assets they acquired at $625 million. And this is the key insight into the value proposition.
And the vast majority of that value.
The vast majority, $605 million of it, was attributed to management contracts with an 11-year average useful life.
Explain that for the listener. $605 million in management contracts. Is Apollo basically just paying for guaranteed rights to fee streams?
Precisely. That's exactly it. Think of it as prepaying for the right to manage Bridge's existing client base and their assets for the next decade. Management contracts represent the expected future stream of fee-related earnings from the AUM they just inherited.
So the $20 million for the trade name is secondary.
It's secondary. The real value Apollo bought was that predictable, long-duration fee revenue stream attached to Bridge's relationships and platforms.
Okay, let's talk about the immediate financial impact, which wasn't pretty, but management probably considers it just noise. Bridge contributed $23 million in revenue for the partial quarter. However, the initial integration resulted in a net income loss of $41 million.
That loss is entirely expected. The bulk of it, $27 million, was just transaction and integration costs incurred right at closing. Plus amortization of the acquired intangibles and other expenses. You pay the cleanup costs and you start realizing the revenue stream at the same time. Long-term, Bridge is expected to contribute positively to both FRE and SRE. That initial loss is just the cost of accelerating their growth plan.
Let's shift to the balance sheet. Athene, through AHL, was active in the financing markets during Q2, which affects the Q3 structure. What did they issue?
AHL issued significant new debt, really optimizing its capital stack for the long term. This included $1 billion of 6.625% senior notes due in 2055.
That's very long-term debt.
Very long term. And another $600 million of 6.875% subordinated debentures, also due in 2055. This issuance provides highly durable, long-term capital that's necessary to back those long-duration liabilities and support the growing size of the Athene balance sheet.
Interestingly, while their long-term permanent debt increased, their short-term financing liabilities went down dramatically. Repurchase agreements payables dropped substantially down to about $2.8 billion at the end of Q3.
Right, which is a material change from the $3.1 billion at the end of Q1, and especially from the nearly $5.7 billion they held at the close of last year.
So what does that signal?
It's a clear signal of strategic de-risking. The biggest reduction was in payables due in less than 30 days. That category went from almost $3 billion at the end of 2024 to just $75 million in Q3. They are moving away from relying on volatile short-term repo funding. It enhances their stability and makes the balance sheet much more robust.
We also saw the fair value of the Stone Tower contingent consideration obligation decrease slightly.
Yeah, from $67 million down to $58 million. This is a legacy obligation tied to an acquisition from 2012. The decrease just reflects a downward adjustment in the value of estimated future performance revenues from that old fund. It's a small, non-core liability.
And this brings us to perhaps the most critical section, the asset quality and the credit health of the underlying portfolio. Especially for Athene, with all the noise around commercial real estate, we have to scrutinize the loan portfolios.
And the data from the filings on commercial mortgage loans, or CMLs, is, well, it's attention-grabbing. The fair value of CMLs 90 days or more past due increased sharply. It's at $282 million as of September 30th.
Which is a shocking increase. It's a shocking increase compared to the $31 million they reported at the close of 2024. That's an over 800% increase in 9 months in highly stressed loans.
That 800% increase is a massive red flag that absolutely demands context. It confirms that the systemic stress we're seeing in the commercial real estate sector, driven by higher rates, shifting utilization, is starting to materially impact even highly disciplined underwriters like Apollo and Athene.
And we see a parallel increase in CMLs and non-accrual status.
We do. That jumped from $93 million to $366 million over the same period. This means they've stopped recognizing interest income on a significant pool of assets that they believe might not recover their full carrying value.
What kind of collateral are we talking about here? Is it all concentrated in office space or is it diversified?
The filings don't break down the specific collateral for that $282 million in past due loans, but Apollo's strategy generally favors essential use real estate logistics, residential, some selective retail. However, any portfolio of this size is going to have exposure to assets that become impaired in a rising rate environment. This rise is a material concentration of stress, and it means management will have to dedicate significant workout resources to this specific part of the CML portfolio.
In contrast, residential mortgage loans, RMLs, they seem to be stabilizing. The value of RMLs 90 days past due actually decreased slightly to $800 million in Q3 from about $847 million at the end of 2024.
And that divergence is important. RMLs, which are often backed by single-family homes or government-guaranteed debt, operate under very different credit dynamics than commercial property. While $800 million in past-due RMLs is a large number, its stability suggests the stress is highly concentrated in the CRE sector, not in the broader consumer housing market. And that's a good sign for systemic risk.
So how did management address the credit environment on the call, especially when they were pressed on the CRE weakness?
They maintained a very disciplined stance. They acknowledge the market concerns, but they consistently emphasize that their focus is on proprietary origination and disciplined underwriting. They use strong language, saying they believe a lot of the market's perceived credit stress comes from bad actors or poorly underwritten loans, not a fundamental flaw in the private credit market itself.
And they provided a very specific comparison to defend how attractive private credit still is.
That's a key piece of data. They noted that private credit spreads, while tighter than their pandemic peak, they remain very wide compared to the public high-yield index. Specifically, they quoted private lending spreads currently running at SOFR plus 450 to 500 basis points.
Whereas the high-yield index
is trading inside 250 over. So that 200 to 250 basis point differential, that is the economic justification for their entire proprietary origination machine. It's the excess margin they capture by sourcing, structuring, and holding private assets.
Finally, their stated strategy on structured products like CLOs reflects a clear risk-off approach.
Correct. They confirmed explicitly that they are constantly upgrading the CLO holdings. They're prioritizing higher credit grades, AAs and As, over the riskier, lower-rated BBB and BB assets. They know that owning BBBs might look better on paper in terms of ROE, but their current focus is cycle management. It confirms their disciplined approach. They're sacrificing some potential return for greater credit stability right now.
So to sum up the credit discussion, Apollo is not immune to CRE stress, but they are mitigating risk elsewhere by locking in attractive spreads in private lending and upgrading the quality of their structured product holdings. To really understand Q3, we have to set the stage with the macroeconomic environment they were operating in.
Right. Q3 2025 was defined by continued, if slowing, economic resilience and an evolving rate picture. U.S. GDP had increased by 3.8% in Q2, suggesting resilience, though the IMF was projecting a slower pace of expansion to 2.0% in 2025.
Inflation was still a concern. The U.S. annual inflation rate was at 3.0% at the end of Q3, which was actually up from 2.7% in Q2. And this persistence forced the Fed to keep adjusting policy.
The Fed was easing, though, which signaled confidence that they could tame inflation without a hard landing. They cut the target rate by 25 basis points in both September and October, setting the range at 3.75% to 4.00% by the end of Q3. This is the environment Apollo is deploying capital into: high rates, but with a softening central bank outlook.
We also saw dollar strength, which impacts foreign investment returns.
Yeah, the U.S. dollar strengthened in Q3. The euro depreciated 0.5%, and the British pound depreciated 2.1% against the dollar. Mark Rowan, the CEO, he spent some time detailing what he sees as this profound strategic shift: the expansion of Apollo's addressable market from one major capital source to three distinct, massive engines. This is really the philosophical underpinning of their aggressive growth targets.
Historically, the entire alternative asset industry was reliant on what Apollo calls the alternatives bucket.
Correct. That first market is the core institutional client base: pensions, endowments, sovereign wealth funds. That's what funded the first 35 years of the whole industry. The second market, individual wealth, is the massive emerging engine. Management believes this market is rapidly accelerating, and they expect it to match the size of the traditional alternatives market.
And the Q3 inflows seem to confirm this shift is happening right now.
Absolutely. The strong $5 billion of flows that Apollo saw in Q3 from their wealth distribution channels reflects the massive infrastructure they've invested in to access high-net-worth individuals and financial advisors. This is sticky, high-margin capital.
And the third market is the one Apollo essentially engineered with Athene: insurance.
The insurance market is now understood by the entire industry as this massive capital source. Apollo argues that insurers are uniquely positioned to take liquidity risk holding private, hard-to-trade assets for 20-30 years in exchange for higher yields, matching their long-duration liabilities. This insight has created the third massive engine of capital gathering for the whole alternative industry.
And looking ahead, management is still targeting the holy grail of capital.
Yes. They're leveraging their traditional asset management distribution, and they're aggressively targeting the $12 trillion U.S. 401k channel. This is the next frontier. They want to provide guaranteed lifetime income to retirees on a commercial basis. And this move fundamentally requires the industry to scale its origination platforms even further to manage that massive flow of capital.
Let's nail down the hard guidance they provided for Q4. Management expects stability in the spread earnings segment.
For Q4, they're projecting SRE ex notables to be stable to slightly higher than Q3, expected to be approximately $880 million, which corresponds to a spread of 125 basis points.
So they expect the spread to tick up.
They do. This projected stability implies management expects new deployment into higher-yielding assets to fully offset any increase in their cost of funds or runoff in the fourth quarter. And based on the year-to-date performance, they're projecting full-year SRE growth of about 8%.
The 2026 outlook on fee-related earnings, FRE, is highly ambitious. They expect FRE growth to exceed 20%.
That 20% plus target is aggressive, but they provided context that gives you some confidence. Crucially, that growth projection excludes any contribution from their next flagship private equity fund, Fund XAE.
Which they don't expect to turn on until 2027.
Right, first half of 2027. So this 20% has to be driven by current AUM growth and deployment.
And they gave a detailed breakdown of where that growth is sourced from, splitting it between the proven flywheel and new initiatives.
They did. They expect 75% of that high FRE growth to come from existing strategies, what they call the flywheel of origination. This is just crystallization of fees from fundraising they've already completed, higher management fees from existing AUM, and so on.
And the other 25%.
The remaining 25% is expected from clearly defined new initiatives that are already underway, like Apollo Sports Capital and the benefits from Athora's pending acquisition of PIC, a UK insurer. This 75-25 split really provides credibility to the projection.
But despite all this accelerated success, management seems cautious about revising its long-term goals.
Yes, they maintained their average SRE growth projection over the entire 5-year plan at 10%. They acknowledged the early acceleration but said it would be, quote, premature to change the 5-year estimate only 9 months into the plan. They prefer to underpromise and overdeliver, retaining that accelerated success as a buffer.
So, in synthesizing the strategic narrative, the core insight always comes back to the role of Athene as the capital provider.
Athene is described as a massive capital generator. The stability, the scale, the predictability of those fee-generating liabilities gives Apollo this unparalleled financial flexibility. This generated capital can either be systematically deployed into new, profitable investment strategies or
return to shareholders.
Or, if opportunities are lacking, it can be returned directly to shareholders via dividends or buybacks. It's an optionality that other pure-play asset managers often lack.
And